Yeah, you're gonna figure it out, but we're now
I
laughing.
want to
About
know what
Einstein
Charlie
bars,
thinks
right?
about. Yeah, I want to know what
My
Charlie
my
thinks
my
about this
symbols are in
never-ending.
WhatsApp. So what that's worth. Energy services,
Kevin Bakes
Netflix
talking.
again, and Bitcoin
All right,
for me.
and Bakes, I'm just
Yes.
curious what you think of the Nasdaq and the S&P 500 levels, and we just keep grinding higher here. And what are the charts saying? And is this stalling out? Breath kind of looks like it's shitty underneath, and volume slowing. And anyway, so just
Yeah, the only thing, yeah, we'll talk about it online, but the grinding up and the lack of upside volume. Now, last week was Thanksgiving, so you got to put a big asterisk on that. So we'll learn a lot now.
yep.
And
big week next week with the Fed, right?
Yeah, and there's a banking conference too, Steve. That's what I'm going to talk about. In which we'll get some guidance from the bank. It's the Goldman Sachs banking conference, and it's the major one of the year. All the CEOs show up with some guidance. So, if the bank
What day is that?
Well, that's Tuesday and Wednesday.
Where is it?
Okay.
In New York City.
Never heard of it.
Sorry. And in our world, it is the major conference of the year.
Okay.
It is, if banks respond well, they're trading up into this conference because they're expecting good news. We'll see how they act after it. But if they act well afterward, I think the melt up is on because banks tend to lead. They're a significant piece of the S&P. Now, you got to get Mag 7 to participate, and that's not happening, I don't think, Bakes, right?
No, I mean this whole Google versus OpenAI battle rages, and Google. I got to tell you, I use Gemini 3, especially on voice mode. It's phenomenal. I use it for all kinds of stuff, and it's basically like it's my they're riding shotgun for me. And so OpenAI and Microsoft are in real now. This is a game of leapfrog. So Tuesday, someone could come up with some other thing that's unbelievable, and that begs the question: okay, these are wonderful, but it's going to be commoditized because there's 7 competitors, and I don't see this becoming Google search. I see it becoming. I don't have another analogy, but the OpenAI Microsoft ecosystem is under siege, and NVIDIA is under siege to a certain extent.
Yeah, and I keep saying, the software behind these systems is going to get better and better, and you're going to need less and less hardware to run these things as the software makes the hardware more efficient.
Seems like it. But I love your city, by the way, Charlie. The city's got a relative strength high. J.P. Morgan doesn't. The volume's better on city. I sent you Mike Mayo, which is his number 1 pick for the second year. He's going with it.
Yeah.
I think 140 seems reasonable. I can talk about that if you want to. But,
Sure.
We took out that 17-year high. And this is another theme. You take out a 17-year high. Why people think it's only going to be there for 6 months doesn't make any sense to me. Same thing with silver. Silver takes out a 45-year high. Why is it only going to be there for 2 months? It doesn't make any sense. So, Anyway, it's your show, Steve.
All right, let's get this show on the road. Welcome to Wall Street Beats, everybody. Today's December 5th, 2025. Hope everybody's staying warm because it is cold here in the Bay Area.
We're not.
And where I was in Wisconsin this week, it was like 16. So it is cold pretty much everywhere from what I'm hearing. Today I've got Charlie Peabody, our banking and financials pro, and Kevin Bakes Baker, our technical and momentum and kind of master of the charts and master of momentum guy. He knows his charts better than anybody I've met. So let's talk. Let's first talk about these markets in general that just keep melting up. We were talking about this a little bit pre-show. Um, it just seems like there's a kind of complacent just bid. Every dip gets bought, but there's not a lot of follow through on the rips. So what are you guys thinking about this Santa Claus rally and this where the markets stand here? The breadth kind of looks shitty. The up volume looks kind of shitty. Kind of the under the surface doesn't look that great. But what are your guys' thoughts? Kevin, you go first.
Yeah, we've talked about this a little bit offline. The only thing that concerns me is the down volume on the is dwarfing the up volume. I shouldn't say dwarfing. That's probably too extreme. And you have to have a Roger Maris asterisk here. Last week almost doesn't count. You've got 3.5 trading days. People are either away or under turkey comas, and so you don't have the same kind of volume. So we'll see what happens from here. We've got the Fed coming up. I miss Greenspan. I wish all these people would shut up. But anyway, you're going to have all that noise. But again, my issue is the volume is uninspiring, and we're done with earnings. So now it's here to the end of the year. You're window dressing. You're taking tax losses. You're harvesting, and so what's going to move stocks up? Right. I've got a couple thoughts on that we'll get into, but for the general market, for the Qs, again, we talked about this offline. I don't know what was online. You've got the same kind of thing. You have the NVIDIA Microsoft axis under siege and Google winning. And so net, you have sluggish volume in the Qs. Sorry, Charlie. Yeah. I'll shut up. You go.
And you mentioned tax losses. I mean, does anybody really have tax losses in their portfolios this year? I mean, and do you really want to sell before year end to book the gains for 2025? Why not just wait till next year if you're going to sell?
If you have losses, you sell them this year. I mean, that's it. And you do. Yeah. That's my thought. But I'm I'm ruthless. I'm old Yeller. Anything down 15% gets shot.
Yep.
I have nothing like that now, but so be it.
Charles,
my gut, and I talked a little bit about this on Wednesday's show, but my gut is we have some kind of melt up into the new year. 7,000 on the S&P, 7,200 on the S&P, something like that. But the two groups that have to participate are the Mag 7, and there's they're struggling, and then the financials, and we're going to get an update next week on the financials. What I said on Wednesday was, I've had a great year, so I've kind of shut my book down. But coming into October, November, I started taking some profits on some of the stuff that I have big gains on, and I tried shorting things, particularly the large cap banks, and it didn't work. I mean, the last month and a half, I don't think I've made any money. So, shorting this market just hasn't paid off. It's been proven much more resilient than I was anticipating.
Yeah.
So next week, this is what I wanted to, sort of present today. There's a banking conference. It's the major banking conference of the year in New York City, where all the major CEOs will come and present. It's supposed to be focused on strategic, goals and priorities and direction. But there are updates given about the fourth quarter and sometimes some preliminary views of what they're thinking about 2026. So it's an important, date. And the banks are trading up into this conference because investors are expecting, some good news out of the conference. So it'll be interesting to me to see how they trade coming out of the conference because, everyone's anticipating good news. But Jen, I don't know if you can put up the first slide, which would be the earnings per share for the fourth quarter. Generally speaking, this is the large cap bank group that I follow. And if you go to the very bottom right-hand column, you'll see that we're looking at a 16.6% increase in earnings per share year over year in the fourth quarter for my group of banks. And that's pretty robust. And according to FactSet, total financials, which would include insurance companies, consumer finance, other types of financial companies, are going to be up, mid to high single digits. And the S&P in the fourth quarter are going to be up, 7.5%. These are FactSet numbers. So the banks are expected to have very robust earnings relative to the broader financial group and relative to the market. Obviously, no one's buying or selling banks on the fourth quarter. They're looking out towards next year. And next year, we're looking at mid-teens growth for this large cap group of banks versus high single digits, low double digits for the financial services, broadly speaking, and versus a mid-teen growth for the S&P 500. So these large cap banks are going to grow earnings very competitively, and they're only trading at 51% of the market multiple. So the investment world has started to really believe in financials as the place to be. If you can go to the next one on revenues, I'm going to do this very quickly because I don't know if you can put up fourth quarter revenue. Anyway, the next slide would be fourth quarter revenues. Again, I'm not sure if you can read this, but revenues are going to be in the mid single digits, up 6% roughly in the fourth quarter. And just again to put that in perspective, revenues for the S&P 500 are supposed to be mid single digits. I think 7.3% is what's being projected. So a decent revenue growth, but more competitive earnings per share growth. If you go to the next slide, I wanted to talk about what is it that the buy side institutional investors buying into, and there are three themes that the buy side is buying into. One is share repurchases and return of capital. So the banks are being given capital relief. We just had the SLR, which is the leverage ratio, reduced by roughly 150 to 200 basis points. We will have more capital relief programs in the first and second quarter of next year. And so that means, the banks are going to be buying back a lot of stock, and I'll come back to that. The other is just the deregulatory theme is leading people to believe there is a multiple expansion ahead of us. So less onerous regulations, lower costs associated with that, and higher multiples associated with that. So that's the second theme. So first is excess capital being returned. The second is deregulation. And then the third, which is what this slide is about, is capital markets. Everyone believes that we have a very long runway to capital markets activities. Trading has been very robust in the third quarter. I think it was the best third quarter in history. And investment banking is got a very robust pipeline of deals to come to market. So people are expecting capital markets revenues to drive total revenues at these large banks. On this slide, these are the expectations going into the fourth quarter. At the very top table is total capital markets. The middle table is total trading. And then the bottom table is total investment banking. The only thing I would say here is I'm going to be interested next week to see if these expectations are disappointing. This is the vulnerable part to expectations in my mind, is capital markets. And the primary reason is that you had a government shutdown, so the SEC and the FTC weren't approving a lot of deals in October and early November. And so the question is, did that hamper? Now, when I talk to buy-side institutional investors, they're saying, well, we're going to look through that because we know the pipeline is so robust that 26 is going to be another great year. My position has been 26 will be peak revenues for capital markets. And so the question is, what do you want to pay for peak revenues? And, Steve's can have a different, idea of what he wants to pay versus Bakes versus me. So, but I do think when we get into the first half of next year, we will be looking at peak revenues. So I'm not willing to pay up for them. It's why I tried to short some of these banks, large cap banks, because I thought we were at peak revenues, and that the guidance for the fourth quarter would be a little bit disappointing. But so far I've been wrong. Anyway, next table, if you can, Jen. Just go through these last two very quickly. The other revenue assumption, which is what I'm willing to pay up for, which is why I've been favoring the regional banks over the money center banks. And in fact, in the month of November, we have seen the regional banks starting to outperform the money center banks. So it looks like there is a leadership transition taking place. But the primary revenue driver for regional banks is net interest income. That is the spread you earn off of your deposits when you lend money out to corporations or consumers. And that spread is growing at its fastest rate in the fourth quarter of this year. I don't know if you can see it very clearly, but we're going to grow, net interest income on average. That's that salmon colored column bottom.
Thank you.
About 6%, and that's up from a 1% increase in the first quarter year over year. So we've been accelerating that NII growth all year long. And that's a higher PE type of revenue than capital markets are. And so we are starting to see a little bit of a transition. And, the bank that I've been, highlighting recently is as a new pick is US Bancorp, USB. I don't know if you can pull that up, Bakes, but I'd be interested in what your take is on that chart. But it's a name that has been a show me stock for the past, 3 or 4 years. And it's starting to prove that they're executing on their promises. So let me just finish the last slide. Sorry, Jen, just one more table, and that was the share repurchase table. As I mentioned, this column to the left that has some fill in and some blanks is my fourth quarter or the fourth quarter guidance from the company. Some companies have given guidance already, some haven't, but bottom line is the share repurchase programs are very robust. And for my banks, they're averaging about 4 to 5% of the shares are being bought back. And history shows that you have to, in order for a buyback program to influence your stock, it has to be a minimum of 4%. And that's where the big banks are. They're buying back 4 to 5% of their stock. So it is an influential factor on how the stocks trade. So those are the things that are going to be, updated next Tuesday and Wednesday at the Goldman Sachs Banking Conference. And as I said, the buy side is expecting pretty, good news going into it. The vulnerable part of the revenue story is what's happening in investment banking due to the government shutdown. And so we'll see how they trade coming out of it. So Bakes, I don't know if you have any thoughts about the KRE or the XLF or any individual charts like USB.
A few things. KRE, it looks okay. I obviously want to see it take out these highs. I'm hearing an echo. I don't know what's going on, but I don't have another source on my end. KRE looks okay. And I'm sorry, the other one was XLE? XLF, sorry. Are you there, folks?
Yep, we can hear you.
XLF looks, sorry. Again, okay, I want to see it take out these highs. And I'm struck by the fact that in USB, I want to talk about quickly. This is a new high. I mean, this is really confirming what you just said, that things have changed around at US Bancorp. I wish the volume was a little higher, but you can't have everything. But I want to mention something here. You've been dead right on Citigroup, and what strikes me here is the relative strength is 88, okay, and this is steadily improved since you bought this in the 40s. Here's the long-term chart, which we've talked about for a while. All right, that is a Luis Yamada base. That's 17 years in the desert, and I don't think that you're going to just have 6 months out of the desert. So this looks really promising. The next level to me is 140, and just good for you. Great call, 40 to 108, and I think you have room to run. Mike Mayo, it's his number one pick for the second year in a row. And I just want to bring this up real quickly. J.P. Morgan, all right, the the darling that people genuflect to. The relative strength is 80, and it's diverging. It's you. Citigroup is gathering what J.P. Morgan is spilling to an extent, in my view. So I can't wait to see what you hear and see in New York at your conference. But I think this move away from the Jamie Dimon genuflecting that goes on to Citi, I think that's going to continue. But we'll see.
I would just add, I don't know, Jen, if you can go back to the very first slide, which is the earnings per share expectations. But on that slide, I have my estimates versus the street consensus. And for Citigroup, I'm significantly above the street. I'm at 212, and the street's at $1.81 for earnings in the fourth quarter. So that might be we have a positive earnings surprise at Citigroup if I'm right. That's could get to Bakes's momentum move again. JP Morgan, in contrast, while I again am above the street, JP Morgan, their earnings per share growth on a year over year basis is going to be the weakest of any of the major banks. They're going to grow earnings in total this year, calendar year 25, by about 4%. And over half of that, EPS growth is from share buybacks. So they're not showing a lot of net income momentum. And next year, JP Morgan is supposed to grow earnings about 7% EPS. And again, about half of that is from share buybacks. So there's some underlying slowing in their net income growth. Now, and then you throw on top of that, this is one of the most expensive banks on a price to tangible book. It deserves a premium. It is literally the best franchise in my universe. Best management team, best balance sheet, best franchise, everything. So it deserves a premium. But 3 times tangible book is not something I've seen in my lifetime. So either the banks are being re-rated, ahead of deregulation, or this thing is going to start to underperform. And I've been on the side that while it's the best bank in my universe in terms of franchise management and balance sheet, it's going to underperform. The stock is going to underperform.
Charlie, what's price to book on? What's price to book on Citi? 1?
No, I think it's at like 1.5. Hold on, wait, no, I take that back. It's 1.1 tangible book.
Okay. Just for perspective for our members. I mean, big delta.
Big difference. But JP Morgan's generating a 22-23% ROTCE, and Citi's struggling to generate a 10% ROTCE. So there are reasons for those.
There's a reason, right?
Yeah, but where Citi is headed to is from 10 to 13 to 15 on ROTCE, and JP Morgan probably is going to have a hard time sustaining a 20% plus ROTCE. So that direction is important here.
All right. So Charlie, what are you looking for in terms of next week at the banking conference? Like, what's going to be? Are there any particular flags you're looking for that's going to say, okay, we're kind of getting closer to the top than I thought right here, right now, or this market's just going to continue? Their guidance is pretty much where everybody thought it was going to be. No real changes. This market continues to grind higher.
I think you're going to get guidance on a number of levels. The macro level, they'll probably talk about, the consumer has remained resilient. Corporations are starting to, invest again as certainty comes back into the economy, and that the capital markets are incredibly robust. So that's the kind of thing. I'm sure Jamie Dimon, who tends to speak his mind,
he likes to pour cold water on things.
Yeah, he's probably going to say, I feel like things are extended. I can imagine some sort of communique around that theme. That they feel like the things are not stable on the underlying foundation. But by and large, I think the commentary will be constructive. On the micro front, as I mentioned before, I think capital markets short term are where there's some vulnerability in terms of expectations. But the question is the buy side willing to look through the short term? And then credit quality, again, the numbers do not show a weakening economy, despite some of the delinquency numbers that are thrown around, despite some of the credits that have gone bad. But
there's a lot of narrative about credit quality right now.
Yeah, but I do believe that financial engineering is being used to suppress a trend towards deterioration, and I think we're going to see a lot worse by the second quarter of next year. So I'm more negative on credit than probably what you'll hear from other analysts. Now, again, I've differentiated the banking system and the non-bank system. I think the non-bank system is going to be the epicenter of the next credit crisis, and the banking system is going to prove to be, much more resilient. That doesn't mean that their earnings won't suffer, but the last three recessions that I've lived through, the banks have been capital impaired. There was fears of failures, et cetera. This time around, I think they've managed their risks 10 times better. They're going to come through with their balance sheet and capital intact, and they're going to be able to start growing day one coming out of whatever credit cycle we have. Whereas I think the private equity, private credit, non-bank, some of these consumer non-bank financials are going to be significantly impaired.
Does this 87% chance of a cut next week have any effect, or is it's already priced in, doesn't matter?
Yeah, it's priced in. I mean, I think, you mentioned 87%. What is interesting is going to be what they say about the future. And that other thing that's being priced in right now, Steve, is a hawkish cut. So if you look at, percentages, they dropped to like 30% for January, for March. I forget March, April. You don't get another cut until June, priced in, at over a 50% chance until June of next year. And so that's when presumably Hassett, if he's the next Fed chair, comes into play. What I think is going to be very interesting is how the bond market reacts to Hassett, because he may have the academic credentials to be a Fed chair, he is clearly viewed as a Trump puppet. And so the bond vigilantes may have something to say about, his leadership at the Fed and what that does to the long end. But a steepening yield curve for the banks, as long as it's not too disruptive. I mean, Jamie Dimon keeps talking about we're going to see a 6% long bond. That would be disruptive. But if we see a 4.5%, maybe 5% long bond, that's not too disruptive.
No. Do you think a 25% cut is warranted or necessary next week?
I do not. I think it's a mistake. And I will 2 or 3 weeks ago, I would have said they're not going to cut. And the reason is because they did their 2 insurance cuts. Powell keeps talking about these cuts as insurance cuts. And I thought, okay, they've done enough insurance cuts, and inflation's still running. I didn't see where it came out at 10 a.m. this morning.
2.8.
Huh?
2.8.
2.8? Yeah.
Yeah.
So we've been running closer to 3% than 2% on inflation. And so if they want to be taken seriously about their 2% goal, they should not be cutting.
Does he play politics and not do it?
I thought he would not do it. I really did. But he, listen, he signaled through Williams that it's on the table. So Williams and Jefferson are his 2 close confidants. And we knew that Powell did not have a speech for him prior to the December 10th FOMC meeting. So he sent Williams out instead to, be his proxy for putting a cut back on the table. But, it's going to be a hawkish cut. It's going to be a divisive vote, I think. I've talked about this in the past, but if you look at the 12 voting members, you got three clear doves. You got Bowman, Waller, and Mirren, sorry. And then you've got 3 clear hawks, and that is, I'm looking for my notes. I can't remember, but anyway, you have 3 clear hawks, and then you got 6 in the middle. Powell and Jefferson have not shown their hands. Cook has indicated more of a leaning towards a dove. I think there were 2 or 3 that leaned towards a dove and 2 or 3 that leaned towards a hawk. So you had 5 potential hawks, 5 potential doves, and then you had Powell and Jefferson in the middle that hadn't, indicated. So it's going to be a very divisive.
So you're thinking 87% might be a little aggressive.
I do, yeah. But listen, when you get to this point of the process and you haven't had Nicky Leaks, Nick Timmeros from the Wall Street Journal, out with an article saying this is what is going to happen, then you have to go with what the markets are saying. So I have to accept that a cut is coming, even though I don't think it's the right thing to do.
All right, let's pass it over to you, Banks. I know you want to talk about Netflix. Chart has not been looking good lately, and they just bought Warner Brothers Discovery this morning. I saw.
Yeah, I just want to say that a day without a salmon chart from Charlie is like a day without sunshine. So that just makes me happy.
He likes that salmon color, right?
And we'll start with Netflix. And I'm almost certain you were the moderator of the show where I talked about the spread over the 200-day being so stretched back here.
I remember you saying, "Don't touch it. Do not buy the dip."
I appreciate that, and I think this is why the charts add value. Is that when things are so good, they're bad. When you're so far above the 200-day that every possible good thing is priced in. Well, there you go. And I didn't say it was a short there. I'll be transparent. But something bad is going on here. You gap down on earnings here. You close below the 200-day. That's bad. The 200-day starts turning down. That's bad. This would be my sell discipline. I'd be selling 2/3 here, so a little bit north of where we are. And then you have the 50-day today. And I keep glancing up, and I apologize because people are just panting over Netflix buying Warner, and then the White House response and all that. I don't care. Netflix, I wouldn't touch it. And you had the warning here at 134 or so, and here we are at 104. And this is my don't be Peter Lynch, which is very tongue in cheek, by the way. The guy's brilliant, but the whole buy what, own what you know, buy what you know. That it's irrelevant. You might like Netflix the service. You don't have to like Netflix the stock. And I hope we've been useful to our members here. This is 25-30% that we hopefully got people at least to think about getting out of the way of.
So where do you start thinking about it? Where does it start looking constructive? Is it too early to tell?
It's there's so many gin joints in all the world that I want to walk into.
Just stay out of this one.
Why would I want to walk into? Okay, yes, you can play it for bounces to 120, but I think that's what you're going to get because what do you have? You have people that have genuflected to Sarandos. Is that his name? I think it's his name. The trend has changed. And it doesn't have to, be Cisco in 2000, but you've broken this trend line, and look at this. You don't have to be a chart guy to see that things have changed. And is this acquisition a sign of desperation that we can't find growth? I don't know, but I don't care. There's so many things to do. I need to own 10 ETFs. If you have a stock portfolio, I think 30 is the right number. And just go someplace else, in my opinion.
Okay. Stay away. We will.
I got two more, then we'll get you out of here.
Good call from last time.
Yeah, thanks. I appreciate that.
I know my kids were asking me if we should buy it. We said no.
Okay. I don't think so. We talked about this a few times when I've been on with Bob and Robert Marson. Energy has turned, and it isn't just because because it's 14 degrees and it feels like 5 here in Boston, but finally, after 4 years of dead money, the monthly doesn't even look that good, but the daily. I just bought this.
What's the
this
ticker
morning.
here, Bakes?
This is XES.
Okay.
It is the oil and gas equipment, the drillers and the frackers and the water, the compressor companies, all of those. Halliburton's the number 3 name. Weatherford from Marson is the number 4 name here. And obviously I didn't buy it at the low, but the fact that this is acting this well. Now, granted, nat gas spot has just broken 5. Oil can't get out of its own way. It's at $58.
Yeah.
The U.S. Brent, I don't know where Brent is right now, but this has changed for the better. And I'm a little sentimental here. I got involved with this in the 90s when everybody wanted to talk about Netscape because no one else cared about it. And frankly, the Elliott Wave guys said oil's going to 30 plus, and they were right. And I rode that, and but I'm unemotional about this. When the fundamentals stink, even though I've made money with the past, I go someplace else. This has changed. Oil service is back. The rig count's hardly budged, and maybe it's because people think Venezuela's opening up, Maduro's going to be gone, and you're going to have those oil fields really get worked over by the companies that are in this XES ETF. But it has finally changed. You're finally having the volume pick up, and I think this is going to work.
Yep. Okay.
I got one more, and then we'll get you out of here.
Hey, Bates, can I just make an observation about the energy space? Because I have been remaking my portfolio here in the fourth quarter, taking some money away from, precious metals, putting them into a reflation trade. Because the reflation trade I hear a lot about. So things like copper, aluminum are now finally working.
Copper's
but
ripping.
Energy has been a big part of it, and it is working. And the one thing that I've been buying into is that nat gas breakout. There's a ETF called UNL, and it's it's the 12-month strip for nat gas.
Yep.
And then you want that is then you don't have to pay for the roll, which is just kills you when you buy the front month. So I would urge people to look at UNL. I don't know if you can put that up, but it's breaking out. I think technically you would probably say, it has to get past 10 or 11 on a long-term chart to really break out, but it's got some momentum short-term. UNL.
No, I'm with you. We're blessed. We've got Morris and Marson who have forgotten more about this than I know, frankly. But I think it's all coming together, and I've avoided this for 4 years, and I'm back for the first time in probably more than 4 years, frankly. And I don't see the E&Ps there yet, although Bob's C&Q is hitting intermediate new highs today, and I think he's right about that. So this is going to be a lot of fun, and it's a trend change that I've sort of foreshadowed this over the last 2-3 months. Now I'm putting my money where my mouth is, and I literally bought it before I got on the show.
Yeah. The other name that you and I have talked about in the past that's also looking very nice right now is Ivanhoe Electric, symbol IE.
Yep.
And that's been a monster trade for me as well. That's a copper play.
I'm here with this is COPJ, the junior miners. Ivanhoe, I think, is the number 3 or 4 name if memory serves, and I'm up 30-40% in this at least right now. And there's more to go. So I'm just noting that silver's hitting highs right now. So there's a lot of good things going on. Where there are not good things going on is Bitcoin. And even with my Roger Maris asterisk example, the down volume this is GBTC grayscale. The volume is on the downside. People are getting out of this trade. The 200-day is turning down. The 50-day is likely to slice through the 200-day fairly soon. And I don't know why. I don't really care. But if you're in Bitcoin, I would think of being less in Bitcoin if you are. MicroStrategy I talked about, I don't know, 4 months ago to warn people out of that. That's leverage Bitcoin, and you sure don't want to be anywhere near that. This is a feeble dead cat bounce here that is not seeing follow through. Even the most bullish podcast guys are breaking out in cold sweats when I listen to them now. And I would just don't be anywhere near here for now. It could change, but there's nothing good going on in Bitcoin land right now.
Thanks. Pull up the MSTR chart.
Yeah, while you're doing that,
do I have to? I'm kidding.
Yeah, please.
While you're doing that, Bakes,
Look at that.
and while you're looking at that, let me just say, if Jamie Dimon does talk about some of the vulnerabilities in the system, he's probably either going to, highlight crypto or private credit. But crypto certainly is something I suspect that all the major Wall Street banks are trying to figure out what's going on there. And it's probably not a big enough asset class to take down a system, but it's an asset class that I think people are worried about.
Yeah.
Is Jamie Dimon any fun at cocktail parties? You've hung out with him, I'm sure.
I appreciate his insights, and he speaks in a stream of consciousness, as you know. So very often he says what's on his mind. It comes out.
I love his candor. Yeah.
So it doesn't seem like a lot of fun. I mean, I love candor. I like fun candor. So anyway, I digress.
I appreciate. He's listen,
how many Einstein bars does Jamie Dimon take down in a day? What do you think?
At least a half a
he's
dozen.
one of the few CEOs that can think strategically, has a good sense of the numbers, and is also good at relationship building. So, he's despite the fact that he says what's on his mind, he's actually very good politically as well. So
no, I agree. I agree.
He's built an awesome team around him too. So
yeah,
you got to give him props. All right, boys. Thanks for all the great insights this morning. Happy Friday, everybody. Enjoy your weekend. Stay warm. Follow us on wallstreetbeats.com, and we will see you next week on Monday. Have a great day. Bye, guys.
Thank you, everyone.
Thank you, guys. Thanks, guys.
Thank you, Jen.
Thank you, Jen.